Welcome back, everyone. Next up, we have Trillion Energy. It trades on the OTCQB under the symbol TRLEF and on the CSE under TCF. It's an oil and gas producing company with multiple assets throughout Turkey and Bulgaria. Please welcome its president, Art Halleran. Welcome back, Art. How you doing today?
Not too bad. It's good to talk to you again, Anna.
Good. Well, we look forward to hearing some of your updates. So the floor is yours whenever you're ready.
Okay, I'll just click on the slide. Okay, so a lot of you probably have seen this before. I'm Art Halleran, the CEO of Trillion Energy, and we have a onshore oil field on Turkey, which generates about 3 to 5 million US a year. But the main goal is this offshore Turkey and the Black Sea SH gas field. And so I won't get into much of the technical aspects of it before. I'll just do a high overview and to the point where we have the updates with the financing, and also where the money has gone and where it's going to go and where we are with our drilling program. So this picture right here, this is one of our platforms in the Black Sea, and our idea, or what we're going to do, is do a 17 new well program. So the company highlights are seem to be having a few issues here. We're going to focus on the offshore SASV gas field, and we own 49% in a large infrastructure. The other 51% is owned by TPAO, which is a Turkish petroleum oil company, government funded, and part of the facility we bought are 4 offshore platforms, subsea pipelines, an onshore facility, which had a capex at the time to develop, created about 600 million, and we own 49% of it. Part of that asset was 8 discovered gas fields. 4 fields were put on production in 2007, and they have produced about $350 million worth of gas US in the old price. But 4 of the gas fields were discovered by exploration wells, were mapped, were drill stem tested, so they tested how much gas and pressure evaluation of it, and so they are classified as reserves. Those are part of the assets I'll tell you. Cost of gas keeps going up. All our economics and so on in this presentation are at the $8 to $9 range, because that's when we had our engineering report done. And I would review CSE, and currently right now we're getting $20.96 US an MCF. We only pay 12.5% royalty, and our OPEX are less than $1. And we're also the gas in the area. Turkey imports 90% of their gas, a large percentage of it from Russia, as does Europe. Like I say, we have a very high gas price regime in the area. We've always had it. It's always been $7 for the last 10 years. And also, Turkey is a member of it's a NATO member. And so, as you know, with the invasion of Ukraine, it's been a really tight issue with the gas. The short-term fix, there are none. The type of fix that you're looking at is going to take potentially 2 to 3 years, if not more, because anything that they want to do is going to take a lot of capital and a lot of time. Natural gas really just pick up in a container and pack somewhere. Either you got to have pipelines, or you got to have special facilities to load and unload liquid natural gas. So the price regime is going to stay high in this area. I predict for 2 to 3 years, and a big crunch is going to be coming in the winter of 2023, because the reservoirs are only 50-60% filled, and we're trying to get our wells and so on to capture that high price in the winter of 2023. So again, I already mentioned a little bit of this about the infrastructure, and the important thing about the infrastructure is it's in good condition. It's on production since it was created. It's still on. There's never been any hiccups. And the reason why this project is a good project is all we're really doing is putting on proven gas that's already sitting there onto our into our facility. So again, we have 4 existing natural gas platforms, 4 gas pools that have been produced. Now we have 5. I have 5 additional conventional natural reserves, because one of them is behind pipe, and then 4 pools are out there. And we have 16 kilometers of natural gas pipeline. So to develop the field, we have a 51-101. Again, this is the platform, and this is based on our $8-9 price range. Say currently, when you did the slide, it was 18, but now it's 21. And these are discovered, non-produced, conventional natural gas reserves. So when I say they're conventional, it's just high porosity, good permeability sand, that there's no fracking, no flooding, nothing. You just poke a hole into it and you produce the gas out. We have a third party, this is the 51-101 report done by a third party engineering. And we have a NPV10 of about $77 million before taxes, but this is on their price deck between $8 to $9. So you can basically double that now. The exploration prospects, so we used to call them low risk development. They're follow-up locations, or locations that side of the well control or a small fault block. But we got told by the Security Commission that because there's no well in it, we have to call them exploration prospects, even though they have a probability of success of up to 90%. But our third-party engineering report gives us an NPV10 US, our interest, 94 million, and again that's at $8 to $9, and now we are double that. So again, you cannot really add reserves and resources, because there are different categories of reserves or volumes. However, if you add them, it's 171 million roughly NPV10 GLJ, and we give a management estimate of about 250, which includes a better recovery factor and a couple of penalties that if we raise the money, which we have now, you can remove a million, and that's at 8 to 9. So if you double that, you're talking 340 to 500 million US NPV10 our interest, and that is just on the reserves, the approvals, and the the follow-up locations off those pools. So our plan is we have the 7 discoveries with unproduced reserves. So tested and proven discoveries that plan to be drilled. So if you look on this this slide here, the green are the proven, are the fields that were discovered, were produced, and they actually have platforms on them, and that's where the gas has been produced. So here's the coast, here's the ocean, and there are our 4 platforms. The yellow and the white locations are pools that were discovered with exploration wells, which were tested, mapped. Our reserves, and part of our reserve report, are the reserves of the pools that we're going to drill. So what we're going to do is there's 7 of them, 5 new wells, 2 recompletions. We're going to drill from the existing platform, extended reach to those pools, and that way we can drill and complete within 45 to 48 days. There's no extra CapEx or time for subsea tie-ins or subsea completions. We'll produce the gas right up the casing to our platform and then to the facility. And so any gas we produce within the month, we'll get the check for it on the 20th of the second of the next month. So we'll be putting on 7 wells, 1 every 48 days. The 10 additional exploration drilling that we're going to do are the red blobs here, and we have 10 of them. We have probably assessed from about 50 to 90%. They are where we have either a small fault block or the well control is not good enough, or the well control we have is too far for it to be classified as a reserve. But they're very low risk. They have the same anomaly as all the discovered pools. They're part of the discovered pools. And those, again, we will drill from the existing platforms, except for maybe a large pool out here. So that'll be our 17-well program. The first one is Program A, which will be the one we're doing right now. We projected, based on the cash flow and GLJ's price forecast and production forecast, that we'll be making $3.4 million US free cash flow a month by the time we finish that program. We start making cash right away because as we're getting over 20 bucks, we're getting we're getting $20 US now. So you can basically double that. So you're talking $7 million US free cash flow, our interest after all costs. And then after Program A, we're up in the range of about $7 to $8 million free cash flow per month at $8 to $9. So, you know, you can, at 20 bucks, you can double that. So you're talking $16 million free cash flow per month, US, our interest. And that's a cash flow that we'll be using to, so the money that we have raised, we'll be drilling the 7-well program, which is Program A. Within a matter of a month or so, we'll be getting gas revenue, and then we'll be using that extra revenue to fund the $70 million program for the other 10 wells. And that's what we call, this is the CapEx circle. Here we have this was just a gap, but the gap now is gone. We have what we raised, we're generating cash flow, and so the yellow part is a continuous drilling that we will get with the cash flow. And the way the rig contract is we guarantee them 100 days of drilling, but that's only 3 wells. And that's just so that we're not on the hook if, say, something totally unexpected happens. But we have it for the full 7 wells. And then after that, it's every time we need to drill a well, we have it. So as long as we keep paying to drill, we have that rig. And so we'll do the 7 and continuous drilling for the next 10 wells. So the Trillion equity financing. So everybody knows March 2022, we did a non-brokered private placement, and I'll show you the next slide why this was important. I closed on about 17.9 million Canadian. That's before fees. We were way oversubscribed, but we cut back because we felt that at 16.5 cents, it was too low. We could have cut back, or I could have cut back a bit more, but my philosophy was I didn't want to cut back to a point where you can never predict the future. We have the money, but it's just not enough to execute anything really substantial, and it sits in the bank. So when I closed on the roughly 18 million, no matter what happened, we could have done something, right? What we ended up doing, and the reason why we did that, the early part is we needed that money for early activity. So rig came up. We didn't want somebody else to snag the rig. So we had to pay $1 million for the reservation fee, MOB, demob. We also did a COVID supply chain evaluation and found out there were some key items that we had to purchase. Because you got to imagine that if we want the casing, say we can't just go and buy the casing from a yard. We actually have to get it made because we're going to drill 20 wells. So we go to the foundry, they give us a ticket, we wait in line, we get our casing, it goes in a container area, it's loaded onto a container ship, it's shipped to Turkey, it's taken off the ship in Turkey, it then is trucked to our shore base waiting for us to use it. And so you can't just turn the switch on. There's a lot of upfront planning. And also some of the items were just not very common because some of the activity has picked up, but that's all been solved. Then in June, we did the brokered equity raise. We raised 22.5 million Canadian before fees. Again, we were very, very oversubscribed, so we cut back. But the end result is we have our money that we need to develop SCSB. And if you look at the markets the last couple of days, I think we would be fairly stressed to raise the money that we would need now. But right now we have the money to develop SCSB. So everybody, not everybody, but a lot of people keep asking me, are we ready to drill by July? Are we ready this and that? And there seems to be a concept that our rig, we're just going to put in the back of a truck and drive it into the place and then start drilling. Whereas actual reality, what I mentioned in the non-brokered private placement, there is a lot of upfront work. And if you really want, you can take a look at the size of this rig. It's just huge. Just go look on YouTube and look up GSP offshore drilling, and you'll see some movement on of these rigs through the ocean. So what we've done for the development so far to show you that since March, we have been progressing to make sure that we have the summer spud date. So we move the rig and we start to actually drill the wells. So again, what we spent to date is about 4.2 million US, and that it was checking all its tripod structures because nothing's been done since 2011. Rig reservation, MOB, well supplies, and also the supply ship, and a bunch of other parts. The US 1.7 million was the 50%, or in some cases 30% advance payment for long lead items and COVID-related problems. So it's like casing, tubulars, wellheads, flanges, all that. We have to have a shore base fixed up. So we spent $76,000 to get that ready. And then we have a bunch of SCSB project admin. So like third-party reserves, third-party trajectories and stuff like that. We're projected to spend to the end of July another 5.3 million. And this is just for to get everything ready to bring the rig, and then we start spending the daily rig cost. And so we're continuing with like the seafloor surveys, well site surveys, continue with the shore base preparation, which will be ready by mid-July for everything. And then we pay the remaining 4.4 million for all the drilling tangibles. and that will leave us with some other costs there. So what this has done is this has allowed us to bring the rig, and so now the spud date will still be this summer, but it'll be around, it'll be in August, and so we'll have all the equipment and everything on the shore base and ready to go. So you can see that we did not spend all this money not to bring the rig. So a lot of people are concerned that this is not going to happen. This money has already been spent to get everything in place to actually drill the well, and then the well will be brought on, and then we'll drill a well and complete it every 48 days and put that on production. So the quick takeaway is we have a lot of value. 340 in NPV 10. Every MCF of gas we produce will be consumed by Turkey because they need the gas. We're a very low gas producer, less than $1 per MCF. Our current gas price now is, like I say, 21, and I suspect it's going to continue to go up. And we can bring the wells on so that in February, January, in the winter of 2023, we actually have our gas wells producing and generating capital. And I want to leave some time for questions. So I have a couple other slides for exploration, which I'll just spend 1 minute. So what you saw before was the proven reserves and the associated development locations from it. So basically, we're just bringing gas on that's sitting there. But we also have low-risk stratigraphic plays that's on the block, identified in seismic, the same stratigraphic level, never been tested. I'm going to put 1 or 2 wells into the best targets, and if they, from my experience, they are gas bearing, and if they have the same production capability of the other fields, we have 13 of these, and they will add the same amount of gas that we've already produced or have produced. And then we also have, this is SASB right here. That's the large 19 TCF discovery by TPAO. We have all the data because we used to have all this land in this area. And so we're going to use the cash that we generate from our SASB, not only to continue developing SASB, but to find a large, potential large target. On SASB, we're talking 10 to 20 to 40 BCF per target. Here we're talking hundreds of BCF and a TCF. So I'll open up for questions.
Okay, great job, Art. We do have some questions for you. We have a question from Rory Jensen. When is the Ohio State Food Consortium Gala event? It was announced previously for May, June 2022, and there was a delay. Was it related to anything PB? Let's see. Let me ask this other question. Florin Werweiserman, is the other 51% interest funded as well?
Yeah, so that's a Turkish petroleum company. And so they're our partners, and it is funded. They haven't said no, but we have the right. So we're working right now with the JV, going over all the stuff. If they don't participate, we can go sole risk, and going sole risk, which means we'll have twice the amount of initial cash flow. So we have the right to go sole risk, but so far it is lined up.
Okay, great. Johnny Otero asks, what do you think of Turkey's rising inflation and the impact this may have on Trillian's ability to conduct business while the conditions in and around the Black Sea remain so volatile, not including the wealth destruction in Turkey from high inflation, which was reported to have reached 80% last month?
Yeah, it was about 70%. And because there's like an invisible plexiglass border in Turkey and outside of Turkey, and Turkey has to buy the gas because they import 90% of it. They set one price. and that one price is based on all external, and it's listed in US dollars. So to answer the question, when you cross over, all the gas is bought in Turkish lira, and because they have to use hard currency to actually bring the gas across the plexiglass border, there's always a correction from the first of the month to the end of the month. So an example would be if we get $20 US an MCF and is converted to a certain amount of lira, by the end of the month, we might be down to say $19 or $18 an MCF, but it is then corrected back up across the border because Turkey wants to conserve its, it doesn't want to pay more for the gas than it actually gets internally.
Okay, that makes sense. Dan wants to ask if you're going to implement a normal course issuer bid in CIB, considering the deep discount actually happening in the market.
Right now, my focus, so there's two actually, when you look at a company, there's two actual businesses on it. There's the share business, and then there is the revenue generating business of the company. And I've seen too many times where too much money is spent to prop up the shares for a short period of time, that they really secure their revenue base. They never really become independent of the market. And so I'm focusing on getting that gas on production, getting the $20 an MCF into our pockets, increasing the value of the company so that the share value will then reflect that. Because right now, if you look at it, we have a market cap, say, of about $80 million Canadian at today's price. We raised $40 million, and we have that in cash or in equipment. So that means value the rest at $40 million. We have an oil field that is $5 million. So 3 times year's cash flow is 15. So that means they value right now, the shares value the SASB project at $25 million Canadian. And that is just wrong. That's just not correct. And so I'm going to generate my revenue. But if in the future I'm getting $15 million US a month free cash flow, and my shares are at 25 cents or 28 cents, I'm going to make more value for the company by picking up my shares on open market than actually bringing on new reserves. But it's important to make sure you have your revenue done first, so you can then have that opportunity to use free cash flow to, like you say, bring value back by bringing those shares back to the treasury.
That makes sense. So Marker Hackmeister asks, at the end of the year, you expect to have 7 wells in production. I know you're looking for further exploration. So how and when do you see a return to shareholders? So as we drill, you're going to have some good news, like we're going to have good tests and stuff like that. And that will start bringing value back to the shares. But as we start drilling, so every 45 days, which is about a month and a half. So we're actually going to have all wells on, probably not in January, but towards March, April. So we'll have that, and then that'll generate cash flow, and we'll just keep reinvesting to do the other 10 wells, which will then be finished towards early 2024. So you're looking at a 1 to 2 year growth. I'm hoping that with the activity and so on, early summer or mid-fall, the share value will start reflecting the actual value the company has in the ground there. All right, we look forward to that as well. Mr. A asks if you can give us an approximate date for the off-block exploration targets in Turkey.
So we've already well advanced in that because we have many reports. So if another company would look at that, it would take them a year, if not more, to do that, because they would also have to acquire seismic and so on. But to answer your question, I'm going to try to get a block so we have it by early fall. But to get any kind of drillable target, you're looking at a 2 to 3 year timeline. But we will have some good news within 6 months to a year to see whether there's something good there or not.
Alex Zisman wants to know, when do you expect the rig to arrive in Turkey, and how long will it take to set up, and when do you anticipate the actual drilling to start?
Okay, so we have everything lined up for August right now, but I'm going to have a rig inspector to go and take a look at the rig. So say it comes off the other location and they want to bring it over to our field. If there's something wrong with it, we have a standby cost. So I'll send an engineer over, the same one that inspected for where it's sitting now. And if there's some major items to be corrected, I will have that repaired at the time. So I don't know that part. And it should only take a matter of, I think, 4 or 5 days to come over. So there's a bit of a sponge, but there is a clause in the contract that if the rig is not there due to the rig contract, the rig company's fault, there's a penalty that they have to pay. So it will arrive there for sure in August.
Okay, great. Frank Suave asks, with current gas prices at $18 US, why has the share price suffered as of late?
Yeah, the current price actually is $21 US. And the only thing I can think about the share price is that we are getting hammered on a short position. We have like millions and millions of shares a day selling to fill short positions because the shares do not reflect the value of the company. I mean, the shares right now, the value of the company just reflects the oil field and the cash we have on hand. So, okay. And the other aspect of it too, although, is that when we do a brokered placement, we're not allowed to do interviews, any news releases, or any kind of IR. But we've now started again, and so hopefully I can get the message out to new eyes. ASDF asks if you can update us on the Bulgaria project, and is Trillion negotiating currently with any company to farm out that far out? Yeah, we're still working on the Bulgarian company. I mean, the property. We were negotiating, so we have a couple in the hopper. We had that was well along the way, but in the end, it didn't turn out. But when I start looking at the $21 MCF cash flow price in Turkey, and the fact that it was $22 a couple of months ago in Bulgaria, I'm looking at maybe it might be better for Trillion to engage that project solely, because the early money is not much, and with a little bit of money, we could end up proving a good asset. And as you know, with the last financing and so on, we've taken a fair bit of dilution. So here we have a fairly large project with some good resources that might really give a good impact to our share value.
We have a 3-part question from David Getty. Start with the first one. When will the platforms, pipelines, and gas processing facility be put back on the books?
Yeah. So the minute we get a the first well or two, and we get a reserve, we can put them back on the books. So that would be when we do our audit, probably 2000. It might be 2022 audit, or it might be 2023.
And what value will be assigned to those assets? So
we had to follow the regulations for depreciation. So in using a normal depreciation without the new stuff we're doing now, because there's going to be a value with that, everything that's been done and so on has a value of our interest of about 50 to 60 million US.
And what annual depreciation will be applied to those assets?
That is above my knowledge level, but I engaged somebody who knew that. So it's already been figured out. The depreciation was to industry security standards.
Thank you for those. Ben Heb asks for you to comment on the fact that the entity who raised the funds in both financing is short is shorting the stock? Also, will the initial spud occur before September?
I don't. So will it? The two parts is I keep hearing the comments that Echelon is shorting the stock, and I would be very careful for people to start saying that without actual having evidence, because the amount of shares that are being shorted are substantially more shares than Echelon has anything to do with, right? I mean, we're talking very large amounts. As for the actual spud date, I'm told that the rig will arrive in August. Whether it'll spud in August or September 1st or August 31st, I don't know. But the rig has to be there before the 1st of September.